Well, let's get back to the markets. Overall, all major averages are in the red so far this week. This comes as tech continues to struggle, and investors are awaiting more from Fed Chair Powell on Friday. So to give you an idea of the recent rotation we've seen, the three worst performing stocks in the Dow this year are the three that are up the most in the last week. Joining us now, Brent Schutte from Northwestern Mutual Wealth Management and Scott Wren from Wells Fargo Investment Institute. Great to have you both here. Brent, I'll kick this off with you. Does this rotation have legs?
I think so longer term. So I'm not for sure in the near term, but longer term, you have to look at small cap, for example, where there's been some rotation. It trades at the second cheapest valuation in the last 25 years. And that time period was 2000. And if you look at the returns since then, even including the last 6 years of large cap outperformance, small caps outperformed by 1.8% annualized. And so to me, I think investors need to look for other opportunities, especially given the uncertainty that's out there and the reality that we don't know which path is forward. So Rick mentioned inflation and unemployment. It's not often that I can come on a show and talk about higher probabilities for both inflation and potentially labor market contraction. And that's where I think the tails are wider. And so that argues more for diversification, not concentration.
Okay. Scott, how do you see this market right now, as I know you continue to like large caps?
Yeah, Morgan, I think really you hit the nail on the head when you use the terms high flyer and momentum. And, you know, high flying momentum stocks, they don't just keep going up every day. It seems like it may be with the group that's led the market higher. But I think it was interesting yesterday that the S&P equal weighted index was actually up while the S&P was down. So I think this is a very concentrated sell-off. I think that there was a lot of money on these names. This speech on Friday is a big deal for these tech stocks. Hopefully we're going to get a good hint, one way or the other, as far as what the Fed's going to do in September. But, clearly, Rick said it. The market, various indicators reflect it. But the market expects the Fed to ease. Personally, I think 84% probability of a cut is too high. But, we'll see. I hate to think that the most powerful central bank in the world is going to make a rate cut decision or possibly several rate cut decisions based on one CPI report and one employment report. I mean, they need to be looking at, much further out than that. But it doesn't seem like that's the case.
Okay. Brent, what do you think? Because the market is pricing in a very high probability of a cut in September, albeit maybe 25 basis points, not a jumbo cut of 50. And Almanac Trader saying that the small cap Labor Day rally is going to be fueled by these Fed cut expectations. You obviously like small caps here. Is that why?
Potentially. I mean, even if there is with potential contraction, think about the opposite side of that, where the economy actually broadens back out because of rate cuts. And so one way or the other, if you stretch your valuation or you stretch your time horizon, I think valuation points to it. Look, you can tell me what the jobs data is on September 2nd, and I'll tell you if the Fed cuts rates or not. I think the market's going to be looking at Powell's speech because the Fed was erring on the side, most participants thinking that higher inflation was a bigger risk. That was before we got those revisions. And so to me, I think people are going to be looking on Friday for any change in that tone based upon those jobs revisions that came out.
Scott, what specifically do you like here, sector-wise? And how much of that is U.S. versus the rest of the world?
Well, Morgan, for sure, we're leaning toward U.S. over international. We've been actually trimming money from small caps. We've been underweight for a while. Small caps kept pace with the S&P 500 for a few-month period. We think that's overdone. So we're underweight small caps. We're trimming money there. We're trimming money from the consumer discretionary sector because, let's face it, two stocks really run that sector. We think they're fairly valued at the very least. What we're trying to buy here is financials. We like utilities. We like technology too, but this pullback here doesn't surprise us. And I mean, if the tech sector pulled back a few percent, 5%, 8% or something like that, I think we'd certainly have some interest there. But we're trying to be patient here. We took some movement. We moved some money into stocks in April when the market came off. We'd like to see another pullback because really by the end of this year, I think stocks probably will be pretty close to where they are right now. But at the end of next year, we're looking for 7,000. So we definitely want to buy on pullbacks. Stocks aren't cheap. We'll see what happens with the Fed. I think that's going to give us an opportunity possibly.